Good evening, class, and welcome to our advanced taxation class. Today, we will be taking the topic double taxation arrangements. Last time, we talked about taxation of non residents, and we saw that a non resident is someone who meets up a certain criteria, such as not being in Nigeria for more than 183 days in a 12-month period, not domiciled in Nigeria, and these are the two basic things. We also look at a company that is a non-resident company. It's a company that is not incorporated in Nigeria. Even if management is done in Nigeria, incorporation is the major means of determining residence of a company. We said today we'll be looking at double taxation arrangement because this double taxation arrangement has a lot to do with non taxation of non-residents. Now we have the tax treaty and double taxation relief. We're going to talk about that. Then we will look at what is called Commonwealth income tax relief. Then the double taxation agreement, the benefits of double taxation agreement. Then we'll see how resolution of conflicts between DTA and the Nigerian tax law was done. Then active double taxation agreement. Then we'll look at some definitions and the Nigerian double taxation agreements that we have. So these are some of the things we are going to be looking at today. So a tax treaty is a formal bilateral agreement made by two countries to resolve issues involving double taxation of taxpayers' income, capital, estate, and wealth between the two countries. So it means it's a bilateral agreement. It's an agreement that is binding the two parties. So that means Nigeria has to enter into a bilateral agreement with another country to resolve taxpayers' um, taxation. So for a double taxation agreement to be binding on Nigeria, it must not only be signed by the appropriate tax authority, it must also be approved by the Federal Executive Council and be passed into law by the National Assembly. So when that is done, the two countries will now be uh, entering into a bilateral agreement. So assuming that Nigeria enters into a bilateral agreement with United States, it means that any income earned in United States and brought in by Nigeria. So that means it's going to be a Nigerian company. Perhaps it is a Nigerian branch, no, an overseas branch, or perhaps an overseas subsidiary. And now the income is being brought to Nigeria. Then it is possible that there is a tax that has been paid by that company in the United States. Now, if they pay the tax there, how will Nigeria treat this taxpayer? Will Nigeria still be charging that taxpayer income tax after suffering tax in the United States? That is what the double taxation agreement is here to solve. When a Nigerian company, because for you to be qualified for this double taxation agreement, one of the qualifications here will basically be a Nigerian company. When a Nigerian company earn foreign income, now that could be by foreign branch or foreign subsidiary, such will be included in its chargeable profit for the year and is subjected to Nigerian tax. We said a Nigerian branch is subject to Nigerian tax. Any Nigerian company that has branch anywhere in the world will be subjected to Nigerian tax. In most cases, the amount that will be received in Nigeria will eventually be taxed twice. First, in the country where the income originated. I gave example of United States. You have a company, you have a branch there, the income would have been charged there before you now brought it to Nigeria where it is received. And when it is received, Nigeria will now have to tax that same income. The tax burden on such income will be unduly high, and it's going to appear as if the company is being penalized somehow because it is earning foreign income. So why would we be penalizing a company that is earning foreign income by charging it tax twice? So in order to minimize the impact on such income, it is reasonable that a kind of relief from Nigerian tax is given to the company. So that's basically what we are doing. Now, when we are having this bilateral agreement, it means if a foreign company is earning income in Nigeria and is taking it from Nigeria to the country where it is belonging to, Nigeria would have charged tax to it, and that company where it is taking the money to will have to provide reciprocal uh, double taxation relief. Section 44 of CETA deals with the specific double deals with a situation where there is no specific double taxation agreement. While in section 45 and 46, we'll see where there is a double taxation agreement. Now, it's just like, how will I put it this way now? If there are partners, let's say two partners, and there are no partnership deed or partnership agreement, there are some situations that can be resolved amicably when there are no partnership agreement. Now, when there are partnership agreements, it will be resolved in the way spelled out in the partnership agreement. So that's the same thing we are trying to do here. When there are no specific double taxation agreements, section 45 deals with that. But when there are specific agreements, then we'll see that specific agreement in section 46, 45, and 46. All right. So the taxpayer in a foreign country, the taxpayer in a foreign country is referred, okay, sorry, the tax payable in the foreign country is called the Commonwealth tax, Commonwealth income tax. So it means that a Nigerian company that is domiciled in United States, if it pays United States tax, it is called Commonwealth tax. Sometimes you see me writing CWIT, CWIT, okay, Commonwealth income tax, CWIT, or you see me writing CWT. All right, anyone you see, know that it refers to the foreign tax that you pay in the foreign country. Now, this is defined in section 44. So you see here, section 44 deals with circumstances where there is no specific double taxation. So when there are no specific double taxation, we'll see something called the Commonwealth Income Tax Principle will be um, looked at. All right, so in section 44, subsection 3 of the Company Income Tax Act, it states that any tax on income or profits of companies charged under a law in force in any country within the Commonwealth or in the Republic of Ireland, which provides relief from tax charged both in that country and Nigeria in a manner corresponding to the relief granted by this section. So it means that section 44 is telling us that there is a reciprocal taxing arrangement between Nigeria and any Commonwealth country, or Nigeria between the Republic of Ireland. Now let's look at this Commonwealth tax relief in section 44. Now, when there is no specific agreement, how should this reciprocal taxing relief be given? Commonwealth income tax relief is given in a company, is given in a situation that a company which has paid or is liable to pay tax in Nigeria for any year of assessment on any of its income is has also paid or is liable to pay Commonwealth income tax for that year in that in that same part of the profit. So it means that this a particular year of assessment, let's say company XYZ is paying tax in the United States of America on that income in year of assessment 2023, and is also going to pay tax in the same income in the year of assessment 2023. Now, and there is no specific agreement between Nigeria and United States, then the Commonwealth income tax relief will be applied. The relief is used to reduce the tax paid or payable in Nigeria on the part of the company's profit that is liable to Nigerian tax, which has already been taxed in the foreign country. So we are not saying that for this to be effective, any claim for Commonwealth income tax must not be made later than 6 years. So it means that you have between the first year till the sixth year to make that claim. After that 6 year, that claim is null and void. For example, if a company wish to claim the common wealth income relief in respect of profit that was earned in 2024 or say 2014, which is subject to tax in the year of assessment 2015, this claim must be made on or before 31st December 2021. So let's count 2015, 2016, 2017, 18, 19, 20. So 2021. So after not less than after 6 years. So it means that if you don't claim it in 2015, you still need to claim it. You have up to 6 years grace to claim it up to December 2021. If the claim is admitted, the amount of tax to be relieved will be deducted from the tax paid for that year of claim or set against the tax which the company is liable to pay for that year of claim. So what it means is that you make your income tax relief and it is admitted and accepted, the year of assessment with which it relates to the tax will be relieved from there. The relief available to Nigerian company from tax on its foreign income shall be, now this is where it gets interesting. This is the principle. If a Nigerian company has already paid tax or is due to pay tax in a foreign company, in a foreign country, and he also wants to pay tax in Nigeria, this is what Nigeria is going to do. If the Commonwealth rate of tax does not exceed one half of Nigerian tax rate, then the Commonwealth rate of tax will be used. So what it means is this. So you say CETA section 44, where no DTA exists. Now, foreign tax, foreign tax is called Commonwealth income tax. So I can say FT, which is foreign tax, you can call it Commonwealth tax. All right. Now let's say Nigerian tax will be NT. So therefore, Nigerian tax rates will be NTR. Then the foreign tax rate, we'll call it FTR. So we said it's still called Commonwealth Commonwealth income tax rate. Let me call it CWR. Let's call it that way. Now, what you now need to do is this. If if it is a Nigerian company, so situation situation one, Nigeria, Nigerian company earns foreign income, income, and no DTA exists. So what happened? You need to bring two things. You need to look for Nigerian tax rates. That's one. You also need to look for Commonwealth rates. That's two. Then you need to also look for half of Nigerian tax rates. Then you also need to look for half of the Commonwealth rates. So what happened? This place is saying if the Commonwealth rate of tax, okay, so sorry, you're not going to look for half. You're going to look for the Commonwealth rate of tax. They're going to look for both Nigerian rates and half of Nigerian rates. Then they said if the Commonwealth rate of tax does not exceed one half of Nigerian tax rates, then the Commonwealth rate of tax should be used. So what you are going to do now, you compare this Nigerian half rate of tax and the Commonwealth rate of tax. These are the two things you will compare. You now say if this Nigerian half rate of tax is greater or equal to this. So if it is greater or equal to appropriate rate, appropriate double taxation relief will be the Commonwealth rate. So it means what it's saying here is if the Commonwealth rate of tax does not exceed one half of Nigerian tax, that means it could be less than Nigerian tax or it could be equal to Nigerian tax. That means Nigerian half of Nigerian tax is higher than the Commonwealth rate of tax. So that's situation one. Then in other case, half of the Nigerian tax rate. So now we are now seeing that if this now is actually less, Nigerian half rate of tax rate is less than the Commonwealth rate, then you will say the appropriate DTR will be half Nigerian tax rate. So what we are saying here is the maximum DTR is equal to half of Nigerian tax rate. So when there is no double taxation agreement, the relief will never be more than half of Nigerian tax rate. So care is taken that we do not give tax relief more than half of Nigerian rate of tax, such that at least the other half can be taxed by Nigerians. So if we are giving you dash, we'll say, okay, we will give you relief, claim relief up to half of Nigerian tax rate. So here it says that the essence here, the rate to be given to a Nigerian company is either the Commonwealth rate of tax or half of Nigerian rates, whichever is lower. So what we are seeing here is to compare these two. So you say DTR is lower of each. So when you compare half of Nigerian tax rates with CWR, whichever is lower is what you will use. So the maximum cannot be more than half, because if CWR is bigger than half of Nigeria tax rate, you will pay half of the Nigerian tax rate. But if CRU is smaller than half of Nigerian tax, you pay the CWR. So the maximum can never exceed half of Nigerian tax rate. That's what we are trying to say here. All right. So let's see an example here. Let's see an example here. Let's say Nigerian company. Let's see an example. XYZ is a Nigerian company domiciled in USA. Okay, then this is the taxable profit happens to be 1 million, right? USA tax rate happens to be, let's say, 20%, right? Nigeria tax rate is what? 30%. Therefore, half NTR should be what? 15%. Because this is the CWR 20%. Therefore, double taxation relief will be lower of half NTR and CWR, which is 15%. So that's it. So assuming USA tax rate is 12%, then DTA will be lower of 12% and 15%, which is 12%. So always choose the lower. So what this is saying here is that USA tax, let's use the first one, 20% of 1 million, that's I've converted it to Naira, the Naira equivalent. 20% of 1 million should be what? 200,000, right? Okay. So what it now means is that Nigeria tax should be 30% of 1 million. That should be what? 300,000, isn't it? Total tax payable, you see here now, it is 500,000. So why should the company be paying 200, 20% and 30% on this? So 500,000 is the tax payable. Now, therefore, double taxation agreement, which is going to be less. You said half of it, 15% of 1 million. That will give us 150,000. So it means it's going to pay 500 minus 150 is going to pay 300 total tax due. So total tax due is 300. Now, how is he paying this 300? It means US tax is 200. Nigeria tax is 300 minus 150, which is 150. Total is 300. Sorry, is it 350 or 300 I said? This is 350. This is 350. Let me write it well. So this is 350. So you see how the breakdown is gotten. The 200 in US tax has been paid to US already. But now, out of Nigerian's tax, we are saying we cannot give you the whole 200 you paid in US. We can only give you part of it that is up to half of Nigerian tax. So it means this 150 you are claiming as a refund is to cushion the effect of the 200. So it means they are refunding you 250, 150 out of the 200 of Nigerian of the foreign income tax. Now, assuming again, we said US tax, we said 12%, 12% of 1 million. That should give us 120,000. Then this is Nigerian tax. Nigerian tax, which is 20% of 1 million and 30% of 1 million. Let me write it well so that it will be clear. 30%, 30% of 1 million. Normally, this is 300,000. Total tax due should be 420,000. So this is total tax due, total tax payable, the total tax incurred. Let me use the word incurred. So that's the right word. Total tax incurred. Then that's a less double taxation agreement, or let's say double taxation relief. That's it. Double taxation relief. That's the word I should have used here. Same thing I should have done here. Double taxation relief. DT relief. Okay, let's double taxation relief. We said is between 15, half of 30, which is 15, and 12, which is 12% of 1 million. So 12%, which is going to be 120,000. So it's going to pay 300,000. So total tax payable is 300,000. Now, how is it so? Tax paid in USA, because that's 120. Tax paid in Nigeria is going to be 300 minus 120 that was paid in US. So that should give us 280. Sorry, 180. So he's going to be paying 180 in Nigeria. So if you add the two, what he has paid in US And what is now remitting to Nigeria is going to give us 300,000. So in all cases, you see here that the smaller of the tax rate is being used. Smaller of the tax rate is being used. So that's what we are saying here. If the rate of tax for CWRO is smaller than half of Nigerian tax, then the double taxation agreement will be used at CWRO. But if half of Nigerian tax happen to be smaller, then you will have to use half of Nigeria. So by no way will your DTA or DT relief be bigger than half of Nigerian tax? That's the point we are making here. Now, that's for situation number one, if it is a Nigerian company. So this here is for, sorry, this here is for Nigerian companies. All right. So what about non-Nigerian company? Now, this here is for non-Nigerian company. So what's the rate here? If the Commonwealth rate of tax does not exceed Nigerian tax rate, then one half of the common rate. Then if the Commonwealth rate of tax exceeds Nigerian rate, the amount by which the Nigerian rate exceeds one half of the Commonwealth rate. So we have looked at situation one here. Situation one here, we said Nigerian company earns foreign income. No DTA exists. Now in this case here, non-Nigerian company earning Nigerian income. A non-Nigerian company earning Nigerian income. So situation two, foreign company in Nigeria earning Nigerian income. So what we'll do here is we'll bring the foreign tax, which is the Commonwealth rate of tax. We'll also bring Nigerian tax. But now if you see here, we'll also bring half of the Commonwealth rate of tax. So what you should notice here, Nigerian company, in Nigerian company, we brought half of Nigerian tax, isn't it? But in foreign company, we are bringing half of the foreign tax. So, but notice now, look at the comparison. The comparison will now be if CWR is greater or perhaps equal to, sorry, let me call this on Nigerian tax rate. Nigerian tax rate. is equal or is greater than Nigerian tax rate, then your DT relief will be half of CWR. So whenever this foreign tax rate is bigger than the Nigerian tax rate, you will say you will use half of the Nigerian tax. That is what it means here. If the Commonwealth rate of tax does not exceed the Nigerian tax rate, one half of the Commonwealth rate. Now, if okay, so sorry, I flipped it. So sorry. In the case of this here, we use less. We use less than or equal to. Let me be consistent. Okay, we said Nigerian tax was written first. Okay, if Nigerian tax here, okay, this is half here is greater than this. So let's put the Nigerian tax first and be using that to compare. So let's get it clear. If Nigerian tax rate is greater than or equal to Commonwealth, that means this Commonwealth rate of tax does not exceed Nigerian tax. That means it's not bigger. So that means Nigerian tax might be bigger than the Commonwealth, or Nigerian tax might be equal to the Commonwealth. Once Nigerian tax is bigger than that, use half of the Commonwealth rate. Then in the second case, if the Commonwealth rate of tax is bigger than Nigerian tax rate, now the amount by which Nigerian tax rate exceeds half of the Commonwealth rate. So it's now saying if NTR is now smaller than the CWR, then what we'll be doing, your DT relief will be NTR minus half of CWR. That is what it's saying. The amount by which the Nigerian tax rate exceed one half of the Commonwealth rate of tax. So we'll do something here so that you will remember the formula. We will say if NTR is greater, okay, no, not NTR, if half, so let's see it here, if half NTR is greater or equal to CWR, DT rate is CWR. If half NTR is less than CWR, DT rate, okay, I will still write it in our board, will be equal to half NTR. So we'll bring these formulas together and put them in place. But let's give an example now. Example 2 here. EFC is a UK company in Nigeria. Okay, taxable income. Let's say this is 1 million naira converted. Then we have UK tax rate, which I would say Commonwealth rate. Let's say it is 35%. Nigerian tax rate, let's say this is 36%. I don't want to be doing fraction. Let me use 36%. 36%. Nigerian tax rate already is 30%. So of course, you would say half CWR should be 18%. So now the first condition is compare. You compare, you have your NTR versus CWR. Now this is 30%. This is 36%. So now you see here, we said if this is smaller, okay, I want to use when this is bigger. Okay, let me change the rate. Let me say this is 26% instead of 36. Let me use 26 and illustrate that first. 26, then this should be 13, 13%. So this is 26 now. So this is 26%. Of course, this is bigger than this. So DT relief will be half of CWR, which is 13%, right? Because it says here, if the Commonwealth rate is not bigger than Nigerian rate, that means it is lower or even equal, take half of the Commonwealth rate. So now let's put it into practical use. So it is going to first of all go and pay Nigerian tax. So Nigerian tax, which is 30% times 1 million. Let me put M, 1 million, which is 1M. That should give you 300,000. So because it knows it is going to go to the foreign land, Nigeria will now less the DTA, less DT relief. So the DT relief is going to be half of 26%, half of 26%, which we know is 13%, right? Times 1M, which is 130,000. Okay, so that will give us 170,000. So this is the tax due in Nigeria. It's going to pay 170,000. Then tax due in UK is going to be 26% of 1M, which is 60,000. When you add them together, 7 plus 6 is 13, 2 plus 2, 4, 430,000. That is what is going to be paid. So in Nigeria, it's paying 170, which has been discounted by half of the UK tax, which is the relief Nigeria will give. Then you will pay 170 in Nigeria, then you will go and pay 260 in the foreign land. Okay, so now in the second example now, in the second example, excuse me, in the second example, UK tax, which is CWR, is 36%. Therefore, half, let me write the half, the other line, so it's not so half CWR will be half of 36, which is 18%, right? So we are saying that we are going to compare Nigerian tax rate versus CWR. Then let me put here DT relief. So Nigerian rate here is what? 30%. This is 36% because this is less than this. So the DT relief will be the difference between, let's read it here. It says the relief against available against the tax on the foreign income. Okay, sorry. Oh, this is another thing here. If the Commonwealth rate of tax exceeds that of Nigeria, that means Nigeria is lesser. The amount by which Nigerian rates exceed one half of the common rate. So what it means here that is going to be NTR minus half CWR. So that's going to be it. So it's going to be minus half of 36, which is as good as saying 30 minus 18. 30 minus 18 will give us what? 12. So that's it. So now, what it now means is this. 30 minus 18 is 12. So why am I having something like 1, 2, 2 here? So this percentage. Okay, so Nigerian tax will be 30% of 1M, which is 300,000, less DT relief, which is now 12% of 1M, which is 120. So he's paying 180. So tax due in Nigeria is 180. Tax due in UK is going to be 36% of 1M, which is going to be 360. So it means here 6 plus 8 has 14. 4 is 540,000. So this is the total tax due. So now you see here, he's paying 36% in UK and he's not paying 36%, he's not paying 30% in Nigeria. If he does that, he'll be paying 66%. Or you see here, he's paying like 18% in Nigeria. is paying like 18% in Nigeria and paying the 36% in the UK. So it means that total is paying 54%. So yeah, you see now, if the if the Commonwealth rate of tax is higher than Nigerian tax, it pays more than when it is lower than Nigerian tax. So you see, when the foreign tax is lower than Nigerian tax, it pays lesser. But if the foreign tax is higher than Nigerian tax, it pays higher. Now, comparing this with a Nigerian company, when the Nigerian tax here, the Nigerian rate is 30, the CW is 20. When the foreign rate of tax is lower than Nigerian tax, is even paying higher. Then when it is higher, okay, sorry, when it is higher than Nigerian tax, okay, so when the foreign tax is higher than half of Nigerian tax, is paying a higher fee. But now, when it is lower, when it is lower, when it is lower than that of probably just a moment. Let me see what I did here. Okay, so when it is lower than that of half of Nigerian tax, is paying lower. So you see, if a foreign tax is bigger, if it is a foreign tax that is bigger, it pays higher. If it is a foreign tax that is lower, it pays lower. Now, assuming we have used these rates, if we have used these same rates that we used before, and we now said US tax is 20, or UK tax is 20, Nigerian tax is 30, we'll be paying half of it. Let's try that and see what will happen. Let's try that. Assuming it was foreign tax is 20, Nigerian tax is 30. Let's make a comparison. So let's say X, Y, Z. This is example 3 now. Example 3, XYZ. Yes, that's the same company, XYZ. XYZ is USA company in Nigeria. US tax, which is its Commonwealth rate, happens to be, let's use the one we used before. Let me see what was done before. We have 20, then we then used, sorry, we had 20%. Okay, we had 20%. Then okay, then we then use the second one, 12%, 20 and 12%. So let's try the 20% first. 20% Nigerian tax, which is NTR, is 30%. So you see here, NTR versus CWR. This is our DT rate. So this is 30%, this is 20%, and we said it's going to be, what was our, we're going to use half of the US, we're going to use half of it. So let's see what's going to happen. So it's going to be half of CWR, which is 10%. So what happened here is Nigerian tax, which is 30% of 1 million, that gives you 300,000, less GTR, which is 10% of 1 million, which is 100,000. So the amount due to pay to Nigeria will be 200,000. So this is the tax payable in Nigeria. Then tax payable in USA is going to be 20% of 1M, which is 200,000. Then total payable is 400. Total tax payable. So now let's compare this 400 here with what we did here in situation 1. It is still the same tax rate, but because it is a Nigerian company, can you see that the total tax is paying is 350, right? Total tax paid is 350 as against 400. Okay, so let's do the second example here when the US tax is 12%. US tax is 12%. Let's see what will happen. If US tax equals to 12%. So of course we know Nigerian tax is 30% multiplied by 1 million, that's 300,000. Okay, sorry, we should have done our comparison first to see the DTA that will be used. So the first thing to do is Nigerian tax rate is NTR versus CWR. This is our DT rate. So we have 30%, we have 12%. So the DT rate will be 30. Sorry, what did we do in the first place here? Sorry, we didn't do this well. We didn't do it well. This what should have, this is lesser. Okay. Oh yeah, we did it well. Nigerian tax is higher than the US. The US taxes, we take half. In the same way too, Nigerian tax is still higher than that. We are going to be using half. We are going to be using half of this. Going to give us half of 12%, which is 6%. Okay, so we have Nigerian tax, which is 30% of 1 million. That gives us 300,000 less DT, sorry, DT relief, which is 6% of 1 million, which is 60,000. So this will be 240,000. And US tax will be 12% of 1 million, which is 420,000. This should give us 360,000 total tax payable. So you see here, he's paying 360 here as against 400. When now this 360, now let's compare it with what we did before. This case here, he's paying 300 and now he's paying 360. So what we just did now is the double taxation relief favors Nigerian companies when there is no double taxation agreement. If it is a Nigerian company based outside, you get more tax relief. You pay lesser tax when you have a Nigerian company outside than a foreign company inside of Nigeria. So that was the point I want to make. So when there is no double taxation relief, you can see that it favors the Nigerian company. Now, if the foreign income of a non-Nigerian company received in Nigeria has suffered Commonwealth rate of 28%, like I said, and that of another company at 50%, with the current Nigerian rate at 30%. For the first company, the rate shall be 28, half of 28, which is 14, which is what we said, since the Commonwealth rate of tax 28 does not exceed that of Nigerian 30. Now, for the second company, when we check half of the Commonwealth rate, 50 divided by 2 is 25. 5%, that is the difference between the Nigerian rate minus half of the Commonwealth rate. So Nigeria is 30%, half of the Commonwealth rate is 15, is 25. So 30 minus 25 gives you 5%. So it's going to be 5% of 5%. Difference between the Nigerian rate 30 and half of the Commonwealth, which is 5%. Okay, I don't know why it is 50% they are writing here. 5%. So that is what it's going to be. Now, it says here again, it is not certain how this provision of the section 44 subsection 2 will be applied to non-Nigerian companies, as such companies are liable to Nigerian tax only to the extent to which their income is derived from the operations of Nigeria. In other words, they are not liable to Nigerian tax on their foreign income. It's only liable to tax on their Nigerian income. Now, readers should note that the relief discussed above will be granted where there are reciprocal provisions in the tax law from the country where the income is derived. That means there must be a reciprocal provision, even though no specific tax agreement has been reached. There is a reciprocal agreement. So now let's summarize what we just did here. Let's summarize what we did here. So, summary. Oh, that's not the spelling. Summary. One, Nigerian company in foreign land earning foreign income. Okay, let me say here, this is Nigerian tax rates. I would say half Nigerian tax rate. I would say this is versus Commonwealth rate, and this is DT relief. Now, if half of Nigerian tax rate is lesser, is greater, let me start with greater, is greater or equal to Commonwealth rate, this will be the Commonwealth rate. If half of Nigerian tax rate is lesser than the Commonwealth rate, to be half of Nigerian tax rate. Now that's for Nigerian company in foreign land. Two, foreign company in Nigeria earning naira. So what we'll do now is we'll start with Nigerian tax rate versus Commonwealth rate. Take note of the difference. And this is your DT relief. So now, if Nigerian tax rate is greater or equal to the Commonwealth rate of tax, it's going to be half of the Commonwealth rate of tax. If Nigerian rate of tax is now smaller than the Commonwealth rate of tax, to be Nigerian rate of tax minus half of Commonwealth rate of tax. You need to remember this principle. It will never be given to you in the exam. So you should find a way to memorize this principle. So how do you memorize it? If it is a Nigerian company in foreign land, you know that it is between half of the Nigerian tax and the Commonwealth rate, whichever is lower. If it is a foreign company in Nigeria, it is between Nigerian tax and the Commonwealth rate of tax. Now, whichever is lower, if Nigerian if the Nigerian tax rate if Nigerian tax rate is higher than foreign tax, whichever is lower, if the foreign tax is lower, we will still use half of the foreign. So if Nigerian tax is lower, then you take the difference between Nigerian tax and half of the foreign tax. So when I say difference, it's possible, it's not possible for the foreign rate of tax to be 2 times bigger than Nigerian tax or more than 2 times. It's not possible. So that means there's no country that will be charging you 60% or 61%. No, because half of that will be bigger than Nigeria. So half of the foreign tax will always be smaller than Nigerian tax. So you find the difference between Nigerian tax and half of the foreign tax. Now we've done with that. We'll now go to a situation where situation three, situation three, where that double taxation arrangement exists. Now, how do we deal with a situation when double taxation arrangements exist? Now, let's look at section 45 and 46. So, the provision of the law states that where double taxation agreement exists between one country and Nigeria, the amount of relief available will be computed on the basis of the provisions of the agreement as contained in section 45 and 46. So you will see now that when there is a double taxation agreement, it will favor you more than when there is no double taxation agreement. Let's see. The points to note is that when there is a double taxation agreement, provisions of section 44 have no effect. So all the things we have been doing in scenario 1 and scenario 2 will never be done in situation 3. Never. Now, foreign tax means any tax paid or payable in a country where the agreement is to be allowed as a credit against tax payable in respect of those profits in Nigeria. So, in this case now, we will not be saying the word CWR because that is when double taxation does not exist. But now you replace it, now you will be using the foreign tax instead of Commonwealth tax. The tax payable on the worldwide income will be reduced by the credits admissible under the terms of agreement. Now, the credit is allowable for only for a Nigerian company. So take note of this point. If it is a foreign company in Nigeria, if it is a foreign company in Nigeria, it is not going to be allowed for the foreign company in Nigeria. So it means here that if there is a double taxation agreement between Nigeria and US, and a US company is in Nigeria, we shall not give that company any double taxation agreement. Neither shall we give him a Commonwealth income relief. We shall not give them because it's not a Nigerian company. But if it is a Nigerian company, of course, the Nigerian company should be in a foreign land earning income. Now, when the company there has been taxed in US, If it's coming to bring the income in Nigeria, we are going to relieve it with that double taxation relief. But if it's a foreign company here in Nigeria, where there is a double taxation agreement, if it's going, we are going to charge the full tax. So US can go and decide to give him a relief. We don't know. All right. The total credit to be allowed for the foreign tax for any year of assessment cannot exceed the total payable for the company for that year. So it means that this is another thing you should note. The total credit to be allowed for the foreign tax in any year of assessment cannot be greater than the total tax that the company is going to pay for that year. In effect, there is nothing like cash refund that can be made for Nigeria. So Nigeria cannot give you cash refund. The highest Nigeria can do is they will say don't pay any tax. The highest Nigeria can do is okay, don't pay any tax. But you cannot claim something that is higher than the total tax you are paying. A company can elect not to take the benefit of the credit available under the arrangement irrespective of the foreign profits earned by it for the assessment year. There may be some reasons why a company might decide not to do that. Any claim for an allowance by the end of, okay, I'm sorry, there may be a reason why the company may elect not to get the benefits of double taxation. And I wonder what could be those reasons. Any claim for an allowance by way of credit shall be made not later than 2 years after the assessment year end. Unlike the Commonwealth relief that is not claimable after 6 years, this is not claimable after 2 years. In the event of any dispute as to the amount allowable, the claim shall be subject to objection and appeal in like manner as an assessment. So that's it. Let's look at the double taxation agreement. A tax treaty or double taxation agreement is a bilateral agreement made by two countries to resolve tax issues. We mentioned that at the beginning. For a double taxation agreement to be binding on Nigeria, it must be signed by the appropriate tax authority approved by the Federal Executive Council. Now let's look at the features. Some of the features, key features of double taxation agreements, double taxation relief agreement is that the names of the two countries involved will be stated together. So it means bilateral agreement between Nigeria and US with the definition of residents and persons affected. So what is going to be the definition of residents in Nigeria? What is the definition of residents in US? We said Nigeria definition of residence for an individual would be if he is uh, in Nigeria for 183 days or is domiciled in Nigeria. For US, it could be that you are a national of US and that will make you double taxation. Double taxation will be ensued. So it could also be that you were born in US and that could be a reason to make you a resident. So that means that there are some people that may be born in the United States of America. Let's assume that being born in US makes you a resident. Then they are now in Nigeria for more than 183 days. They are Nigerian residents paying tax in Nigeria, and they are also US residents by virtue of birth. So they need to state what it means. Then, if it is a company, it could be that Nigeria resident company will be based on incorporation. It is registered in Nigeria. That is what makes it Nigerian company. Then maybe the US will say management is done in US, then it makes it a US company. So somebody might register a Nigeria company and be managing it in US, making the income in US, but managing it there. But it is a Nigerian company. It will suffer Nigerian tax by virtue of registration. It will also suffer US tax by virtue of management. So the definitions of the two countries, what residence is, will be stated. The rates of tax applicable in the countries will be stated with a caveat that changes may be made without notice, or the rate may change without notice. So that caveat should be done, such that if Nigeria now increase their tax rate, it will not be that ah you are now hinging on it that oh when we signed the agreement Nigerian tax rate was 30%. Now Nigeria has increased it to 40%. Or if Nigeria reduces this tax rate to 25%, it will still take effect that way because it has been changed. The transaction on which double taxation relief is applicable will be stated. This will usually be business profit, fees, capital gains tax, personal income tax, and all that. Now, the arrangement for the exchange of information between the two taxations so as to minimize the incidence of tax evasion. So it means that the two countries will be exchanging information. So it means that if the FRS is asking the US government for the activities or information of a particular company in the US that have a bilateral agreement, they will release it. And the same thing, if US is asking for that of Nigeria. Then the appeal procedures in the event of dispute to be stated. Available diplomatic privilege for taxpayers. So there are some diplomats too. All right. So the date of coming into force of the agreement and the possible termination date. So the date that this agreement will start and the date possibly it is going to end. Before that time, they might renew it. Now, connected businesses, including enterprises in the two countries under common control, where where one person has control over the two. So that is connected persons, connected businesses. So connected persons is an individual, connected businesses. So it means one business is a parent, the other one is a subsidiary or a branch. The distinction in industrial and commercial profit, especially for enterprise engaged in business partly in Nigeria and partly in other countries, profit exempt from tax, and all other things. Now we have double taxation agreement with the UK, so we will not need to read this. Double taxation agreement with the UK is there, so you take your time to read on that to see this effect. Now look at the countries that Nigeria have double taxation agreement. So we have all of these here. So you take your time to look at it. The implication of double taxation agreement on withholding tax deduction. Hmm. Withholding tax deduction. What is the implication of double taxation agreement? A company resident in a country with no double taxation with Nigeria. So it means a company that is resident, let's say, let me look at a country, let me look at there's United Kingdom here, there's no US here. I was using US as an example. Now let's use US as an example. So US does not have a double taxation. Let me not use US. Let me use another company. Let's say Ghana. Ghana is not here. Now, if there are no double taxation and the company is in Ghana, but it's a Nigerian company, but it is in Ghana, and there's no double taxation agreement with Nigeria between Nigeria and Ghana, the company will suffer withholding tax at the rate of 10% of the value of revenue from dividends, interest, royalty, and all other tax. So that's what it means. It will still suffer the withholding tax. All right. What is unilateral relief? Unilateral relief is the relief granted to migrants. The effects of international double taxation on the basis of domestic legislation rather than the provisions of a tax relief. So most times questions does not come from here. Then multilateral treaties. I think you should read that up. Most times it doesn't come. Now look at Nigerian double taxation agreements. Permanent establishment. We've talked about permanent establishment in the last class. We've talked about it. Now, taxation of businesses, profits, and income from immovable properties. Now, in business profit, now they said the profit of an enterprise of a contracting state shall be taxable only in that state unless the enterprise carries on business in the other contracting state through permanent establishment. So the profit of an enterprise of that is based in a particular state shall be taxed from that state, except if in the other place it is carrying on a business by way of establishment of permanent establishment. Well, most of these provisions you need to read them. They don't usually ask them in the exams, but you still need to read them up. Looking at examples, let's look at examples here. Let's look at a worked example to understand what is being said here. Before we look at this example, when there is a DTA, let's say Nigeria and UK DTA exists. Okay, so let's say UK tax rate. Let me see what we used before when we did UK. Okay, let's say UK tax rate is 26 and then 36. UK tax rate, let's say 26%. Nigerian tax rate 30%. ABC is in UK but incorporated in Nigeria. So that makes it a Nigerian company, right? Taxable profit, say, is 1 million. So we have, because it is in UK, we'll have UK tax will be 26% of 1 million, which is how much? 260,000. Nigeria tax 30% of 1 million, which will make it 300,000, less double taxation relief. So whatever has been charged in UK, since it is lesser than that of Nigeria, it will be 26% of 1 million. So whichever is lower between UK and Nigeria is what we use. So we are going to 260,000. So that means what he's paying in Nigeria, tax due in Nigeria should be 40,000. Total tax should be 300,000. So total tax due is 300,000. Now, can we look at some of features now? The total tax that this company will pay. Okay, let's look at this with the first one here. This is 300,000 here. Let's look at when it was 26,000 in UK. Let's see. He was paying how much? 430,000. Now as against 300,000. Now let's look at the second example before we analyze. UK tax, let's say this is 36% of 1M. That gives us what? 360,000. I need to put a line here to show that this one has ended. That creates a confusion. Nigerian tax should be 30% of 1 million, which is 300,000, less DTA. Which of these percentage is smaller? 30% of 1M, which is still 30,000. So total payable in Nigeria is dash. So 360 is total tax due. Now we have 360 here as against as against um as against 540. We have 360 as against 540. So you see here that when you have a double taxation agreement, it is easy, it is cheaper for Nigerian companies. So now what do we gain from this? One, the double taxation agreement is the smaller rate between the two countries. Smaller rate is what will be used as the double taxation agreement. That's one. Number two, the double taxation agreement rate will never be higher than that of Nigerian tax rates. So if you look at it now, Nigerian tax rate is smaller than this. We use Nigerian tax rate. Nigerian tax rate is bigger than this. UK, we use UK. So the double taxation rate will never be bigger than Nigerian tax rates. Never, never be bigger than Nigerian tax rate. Thirdly, we said Nigeria will never refund tax. So assuming it were to be bigger, this one will be saying, so you cannot say that you claim everything that you have for UK in Nigeria. You will claim only as much as Nigeria can carry. Nigeria cannot carry the whole of 36%. It has to carry 30% because it cannot be refunding you 6%. The highest Nigeria will do is claim 30% out of the 36 and don't pay us tax. That's another thing to note. Then another thing to note here is this could be in the form of, use it as a memory guide. Look at UK tax, look at Nigerian tax, right? Do you notice that the smaller of the two becomes the relief? The smaller of the two becomes the relief. And the bigger of the two becomes the amount payable. The bigger of the two becomes the amount payable. So if UK tax is smaller than Nigerian tax, UK tax becomes the relief. Nigerian tax becomes the total worldwide tax paid. Now, can you see that the same thing holds here? Because Nigerian tax is smaller than UK tax, Nigerian tax becomes the relief, and UK tax becomes the worldwide tax it has paid. So that's what you should know when there is a double taxation agreement. Now let's look at this question. It's an open-ended question. John Ogu and Co. Limited is a firm of medical practitioners with clinic in Lagos. Okay, so this is domiciled in Lagos. I'll say domiciled. In 2000 and so domiciled in 2017, the operations of the company was extended to a neighboring country. So not only is it domiciled, it is incorporated. Incorporated, domiciled. So now this is a branch to a neighboring country, which is a branch. The result of the business operations for the year ended 31st December 2017 for both domestic and foreign transactions are as follows. Now, because it is a Nigerian company, the worldwide income, both from Lagos and from the foreign country, will all belong to Nigeria. So we have fees, sale of drugs. Now look at the expenses, salaries, electricity, and all that. So we have depreciation of assets. So what we do now, let's look at these things now. Depreciation of assets is not allowable. Now we look at foreign tax suffered. Foreign tax suffered, it is an allowable tax, but we are going to deduct it. I'll tell you why we are going to deduct it. Why are we deducting foreign tax? We deduct foreign tax so that we will have to derive our total accessible profits. We need to find out our total profit or accessible profit. We cannot know accessible profit if we do not add back our tax suffered. So that's why we are adding back the tax. It's not that the tax suffered is allowable. Then we have miscellaneous expenses. I will put a question mark on it. So let's see about that. The capital allowance. This is capital allowance. Of course, it is allowable. The Nigeria is a wholly Nigerian company. That's fine. Miscellaneous expenses might not be allowable because it is not specified if it is wholly and reasonably incurred. Now, what are we told? Required. Compute the income tax liability for the year and clearly stating the double taxation relief applicable to the company. So let's do that. Let's do that. So example from I can study pack. All right. Run of and co limited. Okay. So what are we asked to do? We are asked to look for income tax liability. Income tax liability. And which year of assessment is that? 2018 year of assessment. So we say tax liability for 2018 year of assessment. All right, so let's start. I can decide to put foreign. Okay, so this is Lagos, and this is total. Okay, so we have fees. Okay, we're not going to do it that way. We have this our net profit, right? Start with the net profit. So we say net profit. We have 570, 575 rather, 575. Of course, this total, I'll put a bracket Nigeria because the worldwide income belongs to Nigeria. It's 575,000, and this is 3168. 3168,000. When you add it, 3743. 3743. Okay. One of the things you are going to add back. So let's add back two things now. We are adding back depreciation. Add back depreciation. Depreciation, we have 145, 250. 145, 250. So that should give us 395. What again are we adding? We are going to add back the foreign tax suffered, because I said before, the foreign tax is allowable expense. But what are we looking for when we are doing our add backs? We are trying to know our accessible profit, which is the accessible profit before you paid your tax. So you are going to add back the foreign tax, not because it is not allowed, but for that purpose. So foreign tax, of course, here is dash, and here is 1510. 1510,000. That gives you 1510,000. Okay, so we are going to less. Okay, this is capital allowance. So let's not do that now. So these are accessible profit. So here will be what? Let's activate our calculator that has been sleeping all the while. 575,000 plus 145,000, and that gives us 720. So this is your 720. Now we look for the second one, 3168. Of course, I know it's 1,000 plus 250. I know it's 1,000 plus 1510. That should give me 4928. 4928. Okay, so let's do the last one there, the last end. We have 3743 plus 395 plus 1510. That gives me 5648. All right. So you are not told that the capital allowance, they didn't tell us the capital allowance that was suffered in the United Kingdom. So this 1450 is for Nigerian company. So what you will now do, you say, so this one has ended here. You now say less capital allowance 1450. So dash here because we don't know 1450. So this is the capital allowance it's paying for the whole of Nigeria. So you have taxable profit. Taxable profit, because when you less your capital allowance, your taxable profit now becomes, here is 4,928,000. What about here? Okay, let's remove 1450. That will give me 4198. 4198. 4198,000. Because let's say this is tax. Tax, tax payable. Okay, the tax you paid 1510 here. Let's start. Foreign 1510. See that you have brought it back. So why we added it the first time was because we want to get accessible profit and total profits. But now we've added it back. Nigeria, let's say Nigeria should be 30% of 4198,000. So what would that be? Multiplied by 30%. That should give me 1,259,400. 1,259. 1,259. 1,259,400. Okay, so this is your total profit. This is your total profit. Why am I putting bracket? Not preparing financial statement. So this is your foreign tax. This is your Nigerian tax. Okay. Then we say less less tax relief. Then that is when we will now look. Is there a double taxation agreement? Now, there is no taxation agreement because if it is stated, it must be stated in the question. If there is a double taxation agreement, it must be stated in the question. Then if it is silent, then it's safe to assume that there is no double taxation agreement. So you will now say no DTA. So since there is no DTA, so what you will do, you will go down and do a workings. Workings 1, double taxation relief. Double taxation relief. Now you say no DTA exists. Nigerian tax rate is 30%. Now, because there is no double taxation that exists, and it's a Nigerian company in a foreign land, no taxation exists, and not say Nigeria company in foreign land. Okay, so we will now look for half of Nigerian tax rate, which is what? 15%. Now, what is the CWR? It will never be given to you. Never will it be given to you. You are the one to look for it. So your CWR will be tax, okay, tax paid foreign all over taxable profits foreign. Okay, what is your tax paid? You paid 1,510,000 and your taxable profit is 4,928. 4,928. So When you do that, 1510 divided by 4928 multiplied by 100%, you have it as, sorry, you have it at 30.64%. 30.64%. So clearly, this is higher than that. So you will now look at it and say half of Nigerian tax rate versus CWR, and this is our double taxation rate. So this is 15% and this is 30.64% because this is lower than this. So DTA will be half of Nigerian tax rate, which is 15%. So which is 15%. So you will not say double taxation relief will be 15% of 15% of your taxable profits. So this 4928, 15% of it is what we are going to 4928. 4928. We are only going to take 15% as our relief. So 4928 multiplied by 15, that will give you 739,200. 739,200. So this is your relief, 739,200. We'll now take it down here. 739,200. Okay, this is from workings 1. So this will now be 739,200. Let's remove this from 1259,400. That will give me 520,200. That will give me 520, 520,200. This one will give me 1,510,000. So the reason why this one is small, it took the whole capital allowance. So this is your solution to this problem. This is the solution here to this problem. So that's it. So I would like you to also look at this. AD International Company runs a pharmacy practice in Nigeria and Ghana. The company's operating result for the year ended 31st December 2016 as follows. This from Ghana, this from Nigeria. Total, then we have our overheads and profits. Overheads where this is for that of Ghana, depreciation, donations in Nigerian clubs. Okay, take note here that I don't know the first one if I added back the, sorry, if I added back the miscellaneous expenses. I didn't add them. So just in case you see a different solution from the ICANN pack, they added it back then that's it. But it's not going to be materially different. Since they didn't mention miscellaneous expenses as in the notes as being disallowed, one school of thought might not disallow it. Another school of thought in practice might disallow that miscellaneous expense. So if that is done, that means our add back will be 3 and not 2. And so the tax rate would have been higher. So it's possible our answers may be different from that of the pack because of the um, tax, what do they call that? The miscellaneous expense. Let's see what is stated in the pack. Let's see how it is being solved. So okay. Um, all right. Sorry for the. So we got the same sensible profit. Yes. Now we got the same capital allowance, which is this. Okay. Less capital allowance, we got the same total profit. Yes, we got the same total profit. Then we have 30% of Nigerian tax. 30% is the same thing. Less double taxation relief. Okay. Capital allowance. That's where the difference. I don't agree with the fact that the capital allowance is the same thing here, same thing here. This is okay. This okay. This is Nigerian tax. This is Nigeria. Okay, 15% from where? 40128. Let's see where they got 40. They will see it. Look at the foreign business. We had this. What are the add backs? 250 and the foreign tax. Yes, we have 42928, which is the same thing here. Okay, capital allowance. Oh, the difference is the proration. How did they prorate it? They prorated it. Allocation of capital allowance 145 Okay, the capital allowance is 1450, and we use 145 250. Where is the 145 and the 250 coming from? 145 and 250. Okay, the depreciation ratio. Okay, that is only difference. So that is not a material difference. So it's just that they allocated the capital allowances. So this kind of reduced the foreign tax, and they got tax rate of 37.65, while we got 36 point 30.67. It's not a material difference as much. Is the only difference I see here is the proration of the capital allowance, which is something we've learned from this question. If you are not given how the capital allowance was shared, or you are given depreciation, use the ratio of the depreciation for the two to allocate the capital allowance, because capital allowance is given in lieu of depreciation. Okay, so what we've done is not materially different. And look at that of the other example we wanted to do here. AD Nigeria Limited runs a pharmacy in Ghana and in Nigeria. It's a wholly Nigerian company, they must state it. Assume that is one of the assumption. Assume the company is a wholly owned Nigeria. Now, capital allowances for Nigeria and Ghana, it was given to us here, so we don't need to use depreciation to share it. Now, look at foreign tax suffered, profit attributable to the Ghana business. Okay, compute the tax in tax liability on the total income, stating the double taxation relief. So this is the profit attributable to the Ghana business. Okay, this is how we are going to do this. Take note of the way we are doing this one. So further example from I can pack. All right, so what's the name of the AD Limited? AD Limited, Nigeria company. Then this is 2016. So we are going to be looking for 2017 year of assessment. Tax liability for 2017 year of assessment. Okay, so what are the two things there? Nigeria and Ghana, right? So this is total. Let me call this one. Nigeria is first, okay? So this is Ghana. Let me put GH as Ghana, NG as Nigeria. All right, so we now have income from Nigeria. So this is income. Nigeria is 50 million. So this is 50 million. Ghana is 22 million. Ghana is 22 million. Add them together, it should give you 72 million. Right? Then the next thing is overheads. Overheads. Now, overheads include depreciation. Okay, so what I'm going to do now, overheads is 720, isn't it? So let's look at it now. Depreciation. Let's say depreciation. Nigerian depreciation is what? 4.5. 4.5. Ghana depreciation is what? 750. 750. We add them together to be 5 million 250. 250. So, all right. Then we have donations, 250. So we have donation, because this should be 250. It's a Nigerian donation. That's a dash here, 250. Okay. Then we have foreign tax suffered. Foreign tax suffered. Foreign tax. Of course, Nigeria will be dash here. Ghana will be 4,200,000. 4,200,000. Now leave this profit attributable. Okay. Profit included in the overheads is profit attributable to the Ghana business. Hmm. So what will happen here is, look at what we will say here. Let's do something here now. Look at Ghana. Okay. Foreign tax is supposed to be a negative. So here should be 1,200,000. Okay. Let's look at 22 million minus 750 minus 1,200,000. 20,50,000. Now, profit attributable to Ghana business is inclusive in the overhead. Okay. Profit Ghana. What do they call it here? 5,150,000. 5,150,000. 5,150,000. Let's say yeah, this is also 5,150,000. Now I want you to note something here, that overhead is 40 million. So let's check this all overhead, whether they are all 40 million. 5,250,000, 5,250 plus 250,000 plus 1,200,000 plus 5,150 is less than 1 million. It's less than 40 million. So let's find the difference. 40 million is 28,125. Other overhead, 28,150. So it will be in Nigeria, 28,150. So of course, this is now 40 million overhead. And if you take the 72,000, take it away from 72,000, 32,000 will become the profit. 32,000 will become your profit. So this is 32,000, 2 million. This is 32 million. Okay. Okay. And what I'm seeing here, I've missed a point here. I have to add this 51, this I have to add this 5150 to it. 5150, I will add it to the overhead to increase it. 5150, 33,300. Okay. The reason why I'm doing that, I'll let you know. 33,300. Thirty-three 300. Okay. So this 33,300, this is Ghana 5150. Okay. If the profit here, so this is profit. If the profit here is 5150, these other expenses, which part will go to Ghana? Because if you look at this overhead now, we are adding everything here. Let's add again just to be sure. 5,250 plus 250 plus 1,200,000 now plus 33,300. That gives us our 40 million. Fine. Now they said the profit attributable to Ghana is 5,150. So look at what we are going to do now. We'll start with 22 million minus this profit here, 5,150. Now let's start minusing these ones. Minus 750 minus 1,2,000. That means this is 14,900. So this should be 14,900 here. This should be 14,900. And if this is 14,900, what will be Nigerian part? Let's take it away from 33,300. Nigerian part will be 18,400. This should be 18,400. So what should be the profit here? We have here 50 million minus 4,500,000 minus 250 minus 18,400. That should give me 26,850. So this is 26,850. That's our net profit. Now, from this profit, we have to add back. So we'll start again. Net profit. So this is 28,850. This is 5,150. So that gives us 32 million. Add back, add back. What are we adding? Depreciation. What is the depreciation? 45,750. 45,750. That should give me 5,250. Okay, that's an add back. Then we have donation, 250. Adding back donation, 250. That would be 250. What again are we adding back? Foreign tax. Foreign tax, 1,200,000. Foreign tax, 1,200,000. So when we add, what do we have? We have 26,850 plus 4,500,000 plus 250. We have 31,600. So this is your adjusted profit. So let's do for the second one, which is Ghana. 5,150 plus 750 plus 1,200,000. That gives me 7,100,000. 7,100,000. And let's look for the last one. We have 32 million plus 5,250 plus 250 plus 1,200,000. That gives me 38,700. 38,700. All right, this is adjusted profit. Now let's less our capital allowance. So split it for us here. Nigeria is 3,540, 3,540, 3,540. Ghana is 1,450, 1,450. So when you add 3,540 to 1,450, 3,540 plus 1,450, that should give me 4,990. 4,990. Okay. Then let's look at the taxable profit. Taxable profit here, Nigeria, only Nigerian should give us, I say minus 3,540. Only Nigeria should give us 28,060. What about Ghana? Only Ghana 7171 minus 1,450. That should give me 5,650. Only Ghana 5,650. So when you add the two of the operations, it should give you 38,700 minus 4,990. That should give me 33,710. So that's your taxable profit. Okay? All right. So tax paid. Nigeria and Nigeria will find Nigerian tax, but the foreign tax paid is 1,200,000. Foreign 1,200,000. Nigeria should give us 30% of 33,710. Okay, 33,710 times 0.3. That should give us 10,113. Okay, that's the Nigerian tax. Now let's double taxation relief. Now we'll go to workings. Workings. We were not told if a DTA exists. There is no DTA. One, double taxation relief, no no DTA. No DTA exist. So we start with CWR will be the foreign tax, which is 1,200,000 divided by taxable profit 5,650,000, 5,650,000 times 100%. 1,200,000 divided by 5,650,000 times 100. That gives us 21.24. 21.24%. Okay, that's your tax rate. Now we say half of Nigerian tax rate, which is 15%, is less than, is less than, so it's going to be less than CWR, which is 21, which is 21.24%. Therefore, DTR will be 15%. Now multiplied by, what is the foreign tax? 15650, 5,650,000, which is use 15% on it. 5,650,000 times 15%, that gives me 847,500. So this is your double taxation relief, 847,500. So this is your 847,500. So this is your double taxation relief. So you will say total tax payable. This one will be 1,200,000 here. This one will be less the double taxation. Let me remove it from 10,113,000. That will give me 9,265,500. So this is your tax payable for each of the country. This is the double taxation relief to be granted from Nigeria. So with this now, we come to the end of our class for today. I want to thank you so much for making the class a lively one, and we hope to see you in the next class where a different topic will be discussed. I want you to look at past questions on ICANN and see how you can handle double taxation. Okay, so let me see some of the past questions that you may want to try your hands on. Let's see some of the past questions that you may want to try your hands on. Okay, just a moment. Let's open our question trend. Just a moment. Open with. Okay. I guess by now the question should be showing. That's fine. Now we have double taxation and multiple tax. May a May 2018 question one. May 2018 question one. You may want to look at that. November November 2018 question three. November 2017 question three. So you may want to look at this one again. November 2014 question six. So let me be indicating them here. These are 15th class. Yes. So I can call this A15. These are 15th class. Let me call this A15. This will be another A15. 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 But again, where again? So these are the places where we can see double taxation, and we need to check more current questions to see where you find that. So thank you so much for the time spent in the class. I will see you again in the next class. Do have a wonderful day.